This video is about stock option implied volatility and what that means for option trading. And of course, the implied volatility chart. So if we go to maximumping.com and we go to the Greeks tab, we can see right off the bat for the GE stock, and of course I can change this to any ticker I want, and I can choose multiple expirations, but we'll leave it at GE and the Friday, June 5th expiration. Today is Tuesday, June 2nd. That will be important later on. It gives us 3 days to expiration. But on the Greeks page at maximumping.com, we can actually see the implied volatility, and we can see it charted out. For example, here's the $7 implied volatility, or the $7 strike call implied volatility at essentially 52%. We have the other charts available here too, as the delta, Greek, gamma, and other Greeks. But let's scroll down to the data. We just want to note the headers here, that we have the IV at the left side of the calls table, and then it's right after the bold strike on the put. But let's focus on the call. GE stock price today is actually $7.05. And let's take a look at the $7 call. So stock option price is really two components. One, the intrinsic value, and the other, the time value. The intrinsic value is how much the option is actually worth, right? So today GE closed at $7.05. So if you had options that you could buy GE stock at $7, you could immediately buy the stock at $7 and then turn around and sell it on the open market for 5 cents. So that option has intrinsic value of 5 cents. The other half of it, the time value, is really the expected movement of the stock price between now and the expiration. Today we said it's the 2nd, so that's really 3 days to expiration. Now, how do we determine what that range is? Well, one standard deviation of the implied volatility gives us a range, and that the GE stock will be 68% likely to close within that range. So let's take a look at the math real quick. So our formula is really the stock price times the implied volatility times the square root of the days to expiration divided by the square root of 365. We plug in the $7.05 price, we plug in the IV, we got 3 days to expiration, we got 365. We can work the math out, and it basically comes down to 33 cents. So what do we do with that one standard deviation? Well, you add that 33 cents to the $7.05, and you wind up with $7.38. You also subtract it, and that gives you $6.72. So this range between $6.72 and $7.83 is 68% chance that the GE stock will close within that range, and that's what the implied volatility is telling us. Now obviously we have implied volatilities at different strike prices, and of course we do see the implied volatility chart here graphed out for us at all the various strikes. So that is the implied volatility chart. Thanks for watching.